Welcome to today's explainer on Hindustan Unilever. We're going to unpack the financial health and the strategic future of India's absolute most dominant consumer goods behemoth. Today we're popping the hood, analyzing the latest financial data, and looking at some major strategic shifts to see exactly what makes this giant tick.
All right, let's run through our agenda. First, we'll cover India's FMCG giant. Second, the FY26 financial report card. Third, the pivot to volume. Fourth, the dividend powerhouse. And finally, future risks and triggers.
Starting off with Section 1, India's FMCG giant and its unshakable moat. So, HUL holds a staggering 23% market share. They aren't just playing in the fast-moving consumer goods, or FMCG sector, they literally write the rules. When you wrap your head around the sheer scale of a country as massive as India, controlling almost a quarter of that entire market is just mind-blowing. Honestly, nearly 1 in every 4 products you see on a shelf in these categories, it's theirs. Their supply chain and pricing decisions create ripples across the entire economy.
And they've built this absolute fortress of a distribution network to protect that position. We're talking about over 12 million retail outlets nationwide, plus 1.5 million dedicated rural touchpoints. Brands like Surf, Lux, Dove, you know them, they're woven right into the daily habits of millions of households. Plus, this massive diversification across beauty, home care, and foods means that if one specific sector slows down for a quarter, the others simply step up and hold the line.
This brings us to what makes HUL the ultimate defensive stock. Because, let's face it, people are always going to need soap, shampoo, and basic food items. Their massive scale and incredible pricing power mean they provide really consistent dividends and stable earnings, completely regardless of stock market chaos. They don't rely on some explosive economic boom to sell their core products. They rely on daily human necessity. If you're building a portfolio and you're worried about a recession, this is exactly why analysts constantly point to companies like this one to anchor your investments.
Let's move to Section 2, the FY26 financial report card, which really acts as a catalyst here.
Okay, let's break down the raw numbers and see how that massive moat actually translates into hard cash. Get this. Their net profit hit a monstrous 15,059 crores for the full 2025 to 2026 fiscal year. And that was capped off by a stunning 21% profit jump just in the fourth quarter alone, hitting 2,994 crore. Looking at their sales revenue, they pulled in 63,636 crores for the year. That represents a 41.12% year-over-year profit growth, which, honestly, completely exceptional for a mature, defensive giant that a lot of people assume just moves slowly.
What's even wilder is they pulled this off while keeping profitability incredibly high. Despite rising tea and palm oil costs, which are massive, unavoidable headwinds in this industry, they successfully protected a 23.2% EBITDA margin. For a quick refresher, EBITDA is essentially a measure of their core operational profitability before things like taxes and interest take their cut. The fact that they absorbed those raw commodity shocks without bleeding out their margin speaks volumes about their supply chain efficiency and their premium pricing power.
Moving right along to Section 3, the pivot to volume, and some strategic shifts.
So, defending the castle is great, but to keep the market excited, a giant still needs to show it can sprint. Under CEO Priya Nair, who took the helm back in August 2025, the whole playbook has dramatically shifted. Instead of just passing costs onto the consumer to protect those margins, the new mandate is actively modernizing brands and aggressively pushing for higher sales volume. It's no longer just about defending the moat, it's about getting more physical products into more people's hands.
And her strategy? Well, it's definitely working. We saw a 6% volume expansion in Q4, which represents their absolute strongest performance in 12 quarters. This underlying sales growth is such a crucial indicator. It proves that consumers are genuinely responding to the brand modernization efforts, creating real organic demand rather than just price-inflated revenue. Essentially, people aren't just paying more for the products, they're actually buying more units.
But here's a curveball for you. To fuel this new volume-led growth, we really have to ask, why did HUL complete the demerger of its iconic ice cream business back on December 1st, 2025? It seems entirely counterintuitive to shrink your portfolio when you're supposed to be pushing for aggressive expansion, doesn't it?
Well, that demerger was a highly calculated move for strategic streamlining. Ice cream requires incredibly complex and expensive cold chain logistics. We're talking freezer trucks, specialized storage facilities, delicate handling. By shedding it, HUL freed up massive amounts of capital and leadership focus to double down on high-margin beauty, personal care, and home care innovations where the logistics are far simpler and the returns are stronger.
Which brings us to Section 4, the dividend powerhouse.
and what this means for shareholder payoffs.
At the end of the day, all of this scale and strategic streamlining has to translate into tangible shareholder value, and it absolutely does. We're talking a whopping total dividend of 41 rupees per share for FY26. That translates to an astonishing payout ratio of 92 to 97%. They're essentially returning almost every single rupee of profit right back into the hands of their investors. HUL doesn't just sit on cash, it is a relentless dividend factory.
To put this capital allocation strategy into perspective, let's contrast it. Take a company like Nestlé India, which acts more like a growth engine, reinvesting heavily into digital channels and aggressive expansion, which naturally leads to higher growth, but with a lot more earnings volatility. HUL, on the other hand, is the ultimate cash cow. Their extremely high payout ratio makes them a total paradise for conservative investors who just want predictable, passive income with lower downside risk. They reward you consistently year after year.
Finally, let's look at Section 5, Future Risks and Triggers on the Horizon.
Look, no stock is totally invincible, right? There are some serious headwinds we need to monitor. First up is commodity price inflation, specifically for palm oil, tea, and packaging materials. If those spike further, it's going to severely test those 23% margins we talked about. Then there's the sluggishness of rural demand recovery, which is a major vulnerability given those 1.5 million rural touchpoints they rely on. And finally, the relentless rise of nimble, digital-first, direct-to-consumer or D2C brands, alongside aggressive regional competitors who are constantly trying to eat away at the edges of their market dominance.
So here's the ultimate question we're left with moving forward. Will HUL's volume-led strategy and brand modernization outpace these aggressive, localized D2C challengers in the coming year? Can Priya Nair's volume strategy successfully defend the castle, or will inflation and digital upstarts finally breach the walls of India's FMCG king? Watch those rural demand numbers closely next quarter, because that is exactly where we'll find our answer.